Luis Aguilar, welcome to Acquiring Minds.
Thank you for having me.
Luis, what a story we have for today. You bought a commercial laundry business, then a second one. And the punchline is that you now preside over a business doing north of 5 million in EBITDA. And this all happened in about 1 year's time. Now, so very quick, but a whole lot happened in that 12, 14, 15 months. So we have a lot to cover. Let's get into it. Luis, start us off with some background on you, please.
Awesome. Yeah, thanks. When you say it like that, it's like, be careful what you wish for because it happens so quickly and you kind of forget where you started. But yeah, my background, I'm originally from Guatemala. I grew up there. I came to university. I went to Virginia Tech, studied industrial engineering. Then I went over to work for General Electric, did about 5 years there in a couple of leadership rotational programs. And then I moved over to private equity, middle market private equity in New York City in the operations portfolio team. So basically partnering with middle market companies after we've acquired them. And then, after 10 years of doing that, I really had an ambition to one day buy a business myself. So, those experiences led me to have the capabilities and the desire to explore doing an acquisition myself. And that's when I started learning about search. And that's how I got here.
And exactly how did you learn about search, Luis? Was it from being in private equity or in school or what? Or Googling?
I think my first real deep dive into search, I read the Harvard search fund book, right? Like, I found the book, read the whole thing, and learned about what kind of business you need to look for, what industries, what profile, how to structure it. And this was while I was still working in private equity, maybe like 2 years into my 5-year stint into private equity. So that allowed me to kind of connect the dots and use my job to, learn what I would do if I was going to run a business, right? Kind of learn with somebody else's money, knowing that one day I wanted to do it myself. But really, I was still learning after four years. And then on the 5th year, I'm like, okay, I think I've learned enough. So that was my first real exposure to it. Then I would say I had a couple of friends that did a traditional search and, heard some stories from them of their experience. They were still engaged in their search that they had done. So that's really how I got some exposure to it. And then, as I got into it, I learned more and more about it through, the Stanford study, search investment group, and it's a community in itself.
We're going to also circle back around to your private equity experience and how it informed the deal that you did. But before we move ahead, you were working on the operations side in private equity.
Correct.
You were not doing the deals.
I had exposure to how deals were structured and the whole process, but really we got engaged in the ops due diligence part, right? So when it was time to really assess the company, we would get more exposure to it. Is this a good company? What does the commercial profile look like? So we would start working with the merger acquisition team when a deal is going to go through. And then I was more post-close, partner with a CEO, partner with the team, develop a vision, a strategy, circle back with the M&A team to determine, what other acquisitions we can do. So that was kind of my role at the firm.
And doing that, kind of seeing up close an acquisition and then actually being part of the transition, did you take anything away from that in terms of doing this yourself? And let me maybe give a little bit more context to the question. So many of my guests who have worked in private equity and then decide to go buy a business, they see deals being done in the private equity, at their private equity firm, and they two things. First of all, they notice who's really getting paid, and at the moment of signing on the dotted line, and it's that operator who's having their liquidity event. And so that is appealing. But then they also kind of just see a lot of operators come through and have these amazing exits and kind of learn something about their stories and say to themselves, I can see myself in that person, or at least I can see doing what that person has done. Let me go out and try my hand at this. So did you have any of that kind of channeling, what you were seeing into like, let me try my hand at this?
Yeah, I mean, absolutely. I mean, it wasn't like top of mind all the time, but at the end of my, 5-year stint, I saw 4 different companies, did a bunch of acquisitions, saw the work that I did create tremendous amount of value for these different companies. So I'm like, well, if I was able to do it with somebody else's money, why shouldn't I be able to give it a shot by structuring it myself and create that kind of value, for me and investors that I choose. It was definitely, like, okay, I know I can do it. I know I can work with these companies. Doesn't seem that hard, but it is harder when you do it on your own, right? Because when you're not responsible for the recommendations and decisions and the financial outcome, it's easy to make a PowerPoint and tell a CEO, yeah, you need to grow 10% and go buy these businesses. It's hard to do it. And when I was working in private equity, I acknowledged that, right? I wasn't the guy who just made you a PowerPoint. I would fly out to the companies and be very hands-on. And that was one of the differentiators for me in that space, was because of my background in GE. I know that, a PowerPoint is just a PowerPoint. The recommendation is just a recommendation. And to actually make things happen, you got to go there, sit with people, train people, talk with people. And given that was my approach, I think it gave me even more exposure to what actually needs to get done, right? To buy a company, just to buy it, it's hard, but it's the easy part. To row it, to run it and grow it, and have all these employees on your shoulders, that's kind of the harder part, which I'm just learning.
Well, and I think that may be the theme of this conversation. At least it was the theme of our pre-call. So Luis, okay, so you get the notion to buy a business, you start kind of down the search rabbit hole, you read the books, the Stanford study, et cetera. I guess you start kind of plugging yourself into the ecosystem. You have a couple of friends who did a traditional search fund. Then what? What is it? Pick us back up.
So then it was like, okay, I think I've learned as much as I'm going to learn in my current job. Do I want to do a traditional search or a self-funded search? When do I start it? How do I start it? So really, the hard thing about this is to just get started, right? Because I tried to take it as far as I could before I quit my job. So you have, the stability of your income, and, just explore it as far as you can. And once you're like, okay, this other branch is close enough for me to let go of this one, that's to the point where I got, right? So I had, read all the books. I actually developed a PowerPoint creating my framework, right? Like, what industries do I want to look at? And I used, information from these books, right? Industries that are, growing, highly recession resilient, high barriers to entry. So I narrowed down on 5 industries. And from there, I narrowed down on types of business. I can go into what those businesses were. They were all 5 very different businesses.
Yeah.
And then once I had that framework, I'm like, okay, let me go search for these businesses. So I had narrowed down on pet food manufacturing. There was this trend where during COVID, a lot of people got dogs, and I saw like some tailwinds on the pet food manufacturing. That coupled with my manufacturing experience, I worked for a gummy manufacturing company when I was in private equity. So I was trying to kind of connect dots. Like, what am I good at? What industries have tailwinds? Dog manufacturing. I also had outsourced IT services. I saw a trend that, outsourcing IT, not only in the US, but to Latin America was a up and coming trend. Given my background, I'm like, okay, let me look at if there's some nearshoring IT outsourcing companies based on the trends I'm seeing. And I'm also, sort of tech savvy and enjoy technology. And then
So American clients, Latin
back office.
Latin back
developers.
Office,
yeah.
Mm-hmm. Continue, please.
Then I also narrowed down on the linen rental business. One time I was interviewing for a private equity fund, and the case study was a healthcare linen rental business. This was back in 2015. And I remember, getting into the sim, learning about the industry, preparing this presentation. And what struck about me was 5-year contracts, rental business, cool operations. When I started doing this, I remembered that case, and I actually went back to it and I said, the linen rental in the healthcare space seems like a very interesting business. 95% recurring revenue, 95% of revenue under contract. It's a rental business. It has operations, which I'm good at. And then I looked at the industry trends. It's huge market, recession resilient, and high barriers to entry, right? Mm-hmm. So that was another industry. I'm like, okay, let me look into that. What were the other ones? Oh, I looked at last mile 3PL delivery. Seemed like a big trend, like last mile logistics 3PL businesses,
like an Amazon delivery route sort of thing.
Yeah, it was more like a third party. It's not Amazon, but yeah, sort of like that. There's a bunch of warehouses that Bed Bath & Beyond or Peloton use to store their products, and then these companies deliver the last mile to the end customer. Highly fragmented. I also wanted to look at fragmented industries that had a potential for a roll-up strategy. This was one of the strategies I got exposed to in private equity, is like find a fragmented market, build a platform, and then find smaller targets. And all of these kind of industries met that criteria. Mm-hmm. I can't remember the fifth industry. I'm sure it was something similar. But those were the four that hit my matrix. I made a matrix and evaluated, and then just like, okay, these meet all the criteria. And then I started searching for businesses, on my weekend, on my spare time, mostly on buy, biz, sell. I know many people, think there aren't quality assets there. But what I found is when you find a business on there, half the battle is done, because they want to sell, the price they want, and you're the buyer, right? So real quick, you're like 1/3 of the way, right?
Yeah, that's well put.
So I found all these kinds of businesses I mentioned. I found like 2 or 3, right? And I started practicing. I knew the first business I'm gonna go and talk to, I wouldn't even know what to say, right? So just on a weekend, on the time, I would fill out the form, call these sellers, chat, and maybe I called like 20 people. I met like 2 or 3, and nothing really came of it. This was, maybe June, July of 2022. Then, I started getting some traction, and I actually got started talking to investors, right? First part was just talking to businesses. I don't have anything. Second part is like, okay, how do I actually do one of these deals? What do I need to get? I need investors. I need debt, So I started talking to some investors, like family and friends, stuff like that, and just to feel them out. Like, if I were to do this, would you invest in me? And a lot of the people I talked to, yeah, definitely do it. You have the right profile to do it. So originally I started thinking about doing a traditional search. The people I talked to, they're like, yeah, we'll do it. Traditional search. Just let us know when you're ready to get started.
Was your search geographically focused? Where are you based? How does that play, the geography?
Yeah, it was geographically focused. I decided very early on I wanted to buy a business in Florida, specifically Miami. I had moved down to Miami. I was working in New York, flying back and forth. But I have 2 young kids, so I wanted to provide stability, and the way I thought about it is, if Florida was a country, it would be like the 15th largest country in the world, right? Or something like that. So I'm like, this is a big enough market where I should be able to find a business, right? So I decided I wasn't limited to like only in Florida, but I initially got focused there because I thought, it's a big enough market. It's underrepresented on the private equity space. You don't hear too much about, M&A deals and activity. So it was focused on Florida for sure.
Now I'm thinking of Sam Rosati's 3 big, little 2. The model where if you have 3 criteria, geography, industry, and size, and you're strong on two of them, you got to let one, you got to be kind of weaker on the other. You're strong on geography. You've put a lot of thought into industry. So you're basically strong on industry. Were you therefore much more agnostic on size, or did you also have size criteria?
I would say my size criteria was like 200K in EBITDA to 2 million was my size criteria. I
So you were very flexible on size. 200 SDE is pretty small. You were prepared to buy pretty small.
I saw a couple of businesses doing that, and yeah, I mean, my thought, Will, was like, I'm not gonna be too selective in the business I'm going to buy. There's people who spend many years looking for the perfect business. I knew out of the gate, I want to buy a normal business, an okay business, but I want to be a great operator, right? So doesn't matter, if it's like the best business with the best tailwinds and all the stars aligned. I'm more focused on like something good enough that if I jump in, I'm confident I can grow it and run it and kind of be on the quicker side. I'm kind of biased towards action is kind of the word.
Yeah.
So I'm like, I'll look at anything and whatever comes, if I can get it done, I'll do it. I got lucky that the one I ended up doing, which was relatively quickly, ended up being a good company as well, right?
And so much bigger than 200K in SDE. So
yeah.
and now you're 20 times bigger, more than 20 times larger than that. So that's pretty remarkable. Okay, we're getting ahead. Oh, and then I wanted to ask about your kind of personal financial situation. Were you going to need to raise? I mean, of course, it depended on the size of the business, but were you going to need to raise equity? Did you anticipate, or did you have some of your own, or what?
I had some equity, definitely not enough to get a big deal done, right? So I definitely thought I need to raise some money. I had figured out all the math, like, okay, if I'm going to buy $1 million EBITDA business, maybe I can get it for 3 times. I can get 2.5 million of debt on that. I need 500K, right?
Right.
I had like maybe 300K if you count the 401K. So I was willing to put it all in. And in fact, I did. So I knew I had to raise, my range was like, okay, I just got to get one guy to give me 200K and maybe I can get this done. In the lower end of a deal, right?
So I'm interested then. So yes, of course, you were going to need to raise some equity. You've already said that you were talking to friends and family. But how did these conversations with friends and family, especially if you thought maybe you'll just need, an additional 200 or 300, depending on the size of the deal, how did that evolve into traditional, considering a traditional search fund, which is typically you're looking to do a much bigger business. I mean, that really narrows your options of what you can buy. And it's often for, I don't want to say exclusively, but for the most part, people who are already kind of plugged into, MBA programs where the kind of the traditional search fund investors, are kind of buzzing around. And my impression is, we're kind of just an outsider. You were kind of mid-career type guy coming in and doing this. So bridge that gap for me. How did you consider doing a traditional search fund?
So basically by, August, I'm like, okay, I got some targets. I got some people that are going to invest. I got some practice. I'm ready to kind of quit my job and go and do this full time. I got some promising leads, whatnot, right? So I had enough money where I didn't have to have the traditional search structured already and have that income coming. I had enough savings to, give me a few months to figure it out.
Yeah.
So, very quickly after I quit, I had this deal that I found in BizBuy sell early September, right? It was 1.5 million in EBITDA. It was in the linen rental and it was 20 minutes away from my house, right? So I'm like, okay, this might be the one. So I jump in my car and I go see this guy, and I told you I had learned about linen rental, but I had never been in a plant that did that. I just saw it in a sim, right? And I'm like, okay. So I talked to the guy. We hit it off. He's like a nice gentleman in his 65s. And when you show up to these meetings, you don't have anything. You don't have money. You don't have debt. You just have a poker face, right? So I'm like, yeah, I saw your ad. I'm interested in buying your business. I got some investors behind me, and I got it all lined up. And we talked a little bit about the deal, and he's like, yeah, let's keep talking. So I left that day, and I'm like, okay, 1.5 million. He wants 5 times that, 7.5, and he wants to sell the real estate as well. For I think he wanted like 5 million for the real estate. So he wanted 12.5. So then the search.
That's quite a poker face, Luis.
Yeah, I know. Yeah, I'll get it done, no problem.
Yeah, go ahead.
So then I go back to the drawing board, right? Okay, 7.5 million. Let me go ask investors and let me see what kind of debt I can get. And within a week, I'm like, okay, I could probably get 4 to 5 million from an SBA loan. I actually, getting pre-approved for a loan on the SBA is like getting candy, right? Like you fill out a form online and you're gonna get a term sheet. So I got a term sheet for $5 million. There's a little bit of process. This is the type of business. Very quickly I could put together a little teaser for a few bankers, and got a $5 million term sheet. So then I'm like, okay, I need to come up with 2.5 million more, of which maybe I have 300K. So I went to these friends and family and known investors that I had learned, and they're like, yeah, we'll put 500K each. It was 4. There's your raise, but we keep 80% of the business, right? And you keep 20% over time. I'm like, yeah, 20% of something is better than nothing. So we kind of shook on it really quickly. These guys believed in me, and I brought them along through the process a little bit, sharing like my narrowing of my search, etc. But they didn't really give me money until here's the deal. This is what we have to do.
And Luis, are these actual traditional search fund investors who have done traditional style search fund deals before?
One of them did a deal in one search fund, and he was very successful. And the other people were people in his network that believed that have done business before, right? So he said, I like it. I believe in you. I'll do 500. I have 3 other buddies that will do 500 each. We'll do it like that, right?
And are they modeling what your percentage, your 20% of the business, and only over time that vests or you have to earn it, based on the traditional search fund model, or did they kind of come up with that on their own? Okay.
No, based on the traditional search that the one gentleman had been familiar with, right?
Okay.
So basically, it was a game. The more leverage I get and the more money I put in, the more equity I'm going to get to an extent, and then I'm gonna have, I think 20% was like the carry, and they were pushing back to like, hey, how about just 10? So at this point, I don't have anything. I want to get the deal done, so I'm like, sure. But then along the way, very quickly, while I was getting into it, I got introduced to SIG, Search Investment Group. And, a friend of mine said, why don't you talk to these guys? I think you're giving away too much. This is a great deal. Why don't you talk to these guys? I think there's a way where you can put in like the 200K and get like 80% of the company. I'm like, well, that sounds interesting.
That sounds a little bit better.
Because at this point, I knew about self-funded search, but for smaller deals, right? So for something like 200K in EBITDA, maybe, but this was a little bigger. So I'm like, okay, I'm curious. So this friend of mine introduced me to SIG, and I had a meeting with the SIG team and shared with them the deal, where I had it. At this point, like I had already an LOI with the guy, and they're like, we love this deal. This is a closable deal. We'll make you an offer for you to partner with us, and we'll help you get this deal done. And we get to keep like 80%, 70% of this company. We're pretty confident. We've closed many deals like this. So then that was my first decision hurdle I had to make, right? Like, at one point I have guys that already believed in me and committed capital, but I'm going to end up with a smaller piece of the pie. So, I ended up the decision to, go with SIG, right? I told my investors, hey, listen, guys, I'm going to try and do this one a different way. I appreciate your investment, but we're going to try to structure it a different way. I'll pitch it to you guys afterwards to see if you still want to invest. And they were like, good luck.
Luis, and why you said this was a decision hurdle? Why was it just not a no-brainer to go with SIG, given that the economics were so much more favorable? Because there was uncertainty there?
Yeah, it's the famous saying, a bird in one hand or a bird in the bush, right? These guys already told me they're going to put in the money, and I already have a sure thing. I already have the deal. SIG, I had one meeting with them. They looked pretty legit, but, they said,
Robert and Jordan look legit. Those guys look legit to you.
Actually, how I knew they were legit is I saw Robert's Acquiring Minds debate against traditional search firm. When I learned about SIG, I searched them and I saw the debate. I'm like, okay, this guy has got passion for this concept. So, I felt some altruism to going to that model.
Great, I love that, Luis.
He's probably smirking right now.
And by the way, we keep talking about the $7.5 million for the business. So in case the audience missed it, 1.5 million of, call it SDE. He wanted 5 times $7.5 million. So that's the business price. But he also wanted to sell the real estate for another 5 million. So I also have this 12.5 million number kicking around in my head. What were you going to do about the real estate?
Yeah, that's a great question. So I was negotiating with him. I'm like, listen, I can come up with the 7.5. I can't come up with the real estate. I can, but it'll take longer to do the deal. He wanted to move quick. So I said, like, sell me the business and then give me a couple more months to find investors for the real estate and rent it to me for a while. Give me a right to purchase it and give me a long-term lease. And, I give you my word, I'll try to take it off of you or mortgage it. But it's going to be too hard to try to get both deals done at the same time. He didn't really want it, but he's like, fine, to get this done, I can be a little flexible. But he did not want to retain the real estate, right? So he said, fine. And this is actually why the deal fell apart later on in the story. So we'll get into that, right? So I was able to convince him to lease the real estate for me. And we went about our deal just to buy the business at this point.
Okay. And why do you think a business that has so many favorable characteristics, I mean, of the universe of businesses out there, this vertical, this industry, linen rental, is one of 5 that you identified. And here this business is available for all to see right on Biz Buy Sell. First of all, it's an amazing coincidence. But also, if linen rental, as you'd already demonstrated to yourself, has these incredible characteristics: B2B, recurring revenue, contracts, etc. Why is it on Biz Buy Sell? Why haven't people, the competitors snatched it up, or some other searchers, or the broker? Why couldn't the broker just email his network before putting it on Biz Buy Sell and get this thing sold like that?
That's a great question. I don't really have the answer to it. I mean, I think many of the players who are acquisitive in this space are larger, and they wanted to buy his routes only and not his plant, and his legacy would go away. So he told me, I have these large players, they've made me offers, they want to pay less, and they want me to keep my real estate, and they just take the routes, so to speak, and I don't want to do that. So he said, and then he actually had other offers. Like when we were negotiating, he said he had this hedge fund from New York interested, and he also had a competing party at the same time with me that I later found out who it was, and it was true. So there were other people in the running. I think, we got a little lucky. We gave him what he wanted. We presented, certainty of close, even though I didn't have anything at the time. But, I was like, yeah, I can get this done. And we had a good rapport, right? Sometimes you also got to build a relationship. This guy, his grandfather founded this business. He's been running it for 35 years. So he's emotional about it. And, we spent a lot of time talking. He also saw, when we walked the factory or the laundry or the plant, whatever you want to call it, I was asking very thoughtful, smart questions about operations. So he's like, okay, this guy is not a joke. He's remembering everything. He's asking everything. he can run this place, right?
Yeah.
So I think a combination of those things gave him confidence. This guy might actually be able to pull it off.
Okay. Thank you. Carry on, please.
So
You're talking to Sig. And
Sig, okay.
You got to decide between Sig and your previous investors.
Yeah.
Sounds like you have decided. You let them know, guys, I'm going to go with this group Sig. I'll bring the deal back to you at the terms that me and Sig that we work out, and then you'll get another chance to invest, but they're going to be dramatically different terms.
Yeah.
I'm going with Sig.
Yeah. So I went with Sig, and then immediately they introduced me to they partner with me, right? I have to sign a contract with them that if I do this deal, they're gonna get an interest in the deal. So you kind of choose that path and go there, right? So we have a meeting. We talk about where the deal is at. They help me figure out when we can close this and how we're gonna do it, right? So they partner with me to prepare collateral and the SIM and make introductions to all this SBA lenders that are cash flow based lenders and not asset lenders, so we can get this larger deal done with a little extra leverage. They're like, we're gonna send an email with our marketing material to our network of 400, 500 investors, and then you're gonna pitch all of them, and they help me structure the deal, right? Based on the projections that we think and the hurdle that we want to give our investors using conservative assumptions, we think you can keep 70% of this business and raise, $1.8 million and get debt for the rest, right? So they were more aggressive on they thought I could get 6.5 million in debt from the SBA plus some mezz debt. So the raise would have to be lower, and I could keep more equity, right? So,
and Luis, tell us what mezz debt is. What is that additional? We all know $5 million for the SBA loan. So you're saying now 6.5. So $1.5 million of this is quote unquote mezz debt. What is mezz debt?
It's like a secondary unsecured debt, probably at a higher interest rate that is unsecured, but people are willing to take the risk. And it wasn't necessarily going to be mezz debt. The way Sig told me is, we know some SBA lenders that can get creative and they will take the risk on the incremental. It's still the same bank, but they get some exposure on the incremental 1 million, 1.5 million through lines of credits, etc. So, they just said there's options to get to 6.5.
Okay.
Don't worry about the cap of the 5 million, but the 5 million is the cap on the traditional SBA.
And so when you're hearing all of this, are you pretty psyched that, because one of Sig's big value props is that they're going to help you, self-funded searcher, retain a really large piece of a really large business, really large meaning large for a self-funded searcher. So in this is kind of all becoming clear to you, or at least this possibility. How do you react? I mean, obviously it's better than the offer you had before. Are you psyched? Are you amazed? Are you still just so kind of naive in this world? You're like, okay, I guess this is another option and I'll just go this way.
I mean, at this point, my thought process is a deal isn't done until it's done. I'm hesitant until there's ink on a contract. It's not done, right? So
yep.
Yeah, I got Sig. I'm excited, but at the same point, I still got negotiations with the seller, negotiations with Sig. I got to go get $6.5 million of debt. I still got to go talk to 400 investors to raise the equity. Right. So at this point, I don't got anything, right? I got all the right things, coming about, but I still got nothing, right? So,
a long way to go.
I'm focused on, okay, one step at a time. It's very tough to get a deal done, you got all these things you got to figure out. And I think that's one thing that the traditional search fund is better at, right? Once you got a deal, everything is lined up. You just focus on closing the deal. At this point, I got to focus on many things to actually get it done.
Wait, sorry. Why is it easier to get a deal done with traditional? Because your capital is committed already, basically?
Exactly. Yeah.
Okay. And you're, okay, great. Okay. Carry on then, Luis, please.
So, okay, at this point, all right, I got my deal under LOI. Everything is good. Now, Sig prepares their material, and they send an email to 400 investors, right? And now it's like, okay, Luis, you got to raise $1.8 million from a pool of 400 people. It shouldn't be that hard. So we send an email, and, like, I've never been rejected so many times. Like, out of 400 people, maybe 200 pass. Like, no, not interested. Don't like the business. Too small. I'm used to investing in traditional search funds, but nice try. So a lot of rejection, right? Like I'm not used to that, right? Like, but like 100 reply, yeah, and they want to engage, and they like the deal, and they give me a meeting, right? So I got 100 that actually bid and signed an NDA. Then you start scheduling all these meetings back to back, refining your pitch. You got the presentation. You're really selling, right?
Yeah.
Out of 100 that I got a meeting, 50 like, okay, we want to go to the next level. We want to see the presentation. Let's set up an hour. And at this point, we're fundraising for, like, the goal was to raise the 1.8 million in 4 weeks. At this point, it's like a week and a half, and I haven't raised anything. So I'm starting to get nervous, and the stick guys, this is where they were great. It's like, don't worry, like, it's always slow to begin. Once the first one comes in, they all jump in. So then I remember, like, maybe 8 days into it, a guy who did a self-funded search, he committed 100K on the spot after 15 minutes of talking. I was so happy. I'm like, wow, 100K, only 1.7 to go. And then after that, it started going, a little quicker, but smaller investments, right? Like, all these guys say, oh, I'll do 50K, and you do what is called, like, soft commits. You get soft commitments, like, they give you your word, but they haven't signed anything. So, by the end of 2.5 weeks, I had like 500K of soft commits. And then I had
Luis, after you got that first 100,000, a yes to the first 100,000, did you find that yeses started coming more easily, even if they were soft yeses?
Yeah, for sure. Like,
okay.
You can say, you exaggerate a little bit. Yeah, I got a lot of commitments, but you at least have some commitments. You can name drop a little bit. Everybody knows in the industry. So at this point, I'm like, man, the other deal looked a lot better. I had raised the 2 million already, right? But now it's too late to, the other guys were going to keep 80%. I can't come back and say, hey, same deal, but you get to keep 30%, So I was keeping the old investors in my back pocket at some point. But I kept fundraising, and then my lucky break was this guy who was like the CEO of a big fund here in Miami. He gave me a meeting. I came to his office, and he was like, "This is a little small for our fund, but I might invest, at the personal level." I'm like, "How much would that be?" He's like, "I would probably do like 500K." So I had 500K, and this guy's saying he might do 500K, but he's like, "I'm gonna need some time to think about it." And so, the weekend goes by, and then Sunday he sends me a text of a picture of my truck while he's driving back from vacation here in Miami. He's like, "Did you plant this truck? Because it's my trucks. The trucks I'm trying to buy say size linen." And it's like right in front of him at a stoplight. And he takes a picture, sends it to me, and he's like, "Did you plant this truck?" I'm like, "No, that must be a sign." And he's like, "If you didn't plant it, it's a sign, and if you planted it, I admire you for the hustle." So I'm gonna do 500K, right? So that really got the ball rolling, right? At 1.5, and then the people who are a little slow to reply and give me the meeting, after 2-3 weeks, we keep nudging them. Then they give me the meeting, and it's like, okay, I've raised 1 million now. We only got like a little left. Do you want to get in? And then like a bunch of like 200K checks came in. So we raised the whole money after the 4 weeks, pretty much, right?
Great. So it did all kind of play out the way Sig predicted that it would. And just a little bit, Luis, more on all of this pitching. So your calendar is full. You just have 30-minute or 60-minute calls back to back to back to back for
all
weeks.
Day. Yeah.
All day, every day.
Not all day, right? But like 2-3 meetings every day. And, if following up with a lot of emails, right? Like, hey, following up on this, and like you got to keep that momentum going. And at the same time, I'm still negotiating the deal with the guy, right? Because in parallel, he's saying, hey, I'm kind of changing my mind. We need to sell the real estate. And he calls me 30 days. In the middle of this, he's like, I changed my mind and you got to take the real estate or there's no deal. I'm like, I can't do the real estate. So he's like, then there's no deal. I'm like, come on. Like I showed you the debt. I have the money. Here's the term sheets. I've done all this work and now you pull it under me. He's like, well, the other guy is offering to buy the deal, the real estate. So I'm going to go with him unless you take on the real estate. So I thought he was bluffing. I didn't think he had another offer. And I say, okay. And then he effectively sends me like a termination of the LOI, like no deal. He sends me a letter. And then I call him up and I'm like, this other party was like a competitor. So I'm like, he's going to take your legacy and your father's name of your company away. And, give me a day to see if I can pull off the real estate. And so he's like, okay, I'll hold off in signing the LOI with the other guy. I'll give you a day. So then, I went back to the drawing board and I talked to the SIG guys and they're like, yeah, tell him we'll take the real estate. We'll help you raise debt. There's like other avenues, etc. And see if you can get a seller note on the real estate because the seller didn't want to give a seller note on the business. So I went back to him and I said, I'll take the real estate, but you got to give me a big seller note on the real estate that is secured by the real estate. And he said, I have already signed the other offer. I haven't sent it to my attorney. I like you. I'll go back to doing the deal with you if you take the real estate, and I'll give you a big seller note on the real estate. So at this point, deal is back on, money's raised, and now I got to go get the debt, right? Because at this point, I only had like a preliminary term sheet from the SBA bank. So, okay, we're in business now. Now we got the equity. We're ready to go to the SBA, and this might also be a learning opportunity for the searchers. Like, what steps do you go in to get it done? The SBA usually wants to see that you have the equity lined up before they give you a commitment letter, right? And you also have to have an LOI signed before you get equity or a commitment letter. And that's where, you got to be doing all these things in sequence and have that poker face that all along you had it lined up.
And Luis, one other question about this process. So you talked about how your pitch to investors is being refined with every time you do it. And I'm sure it's very particular to your pitch. But was there anything generalizable about how you improved your pitch to investors or learned how to better communicate this opportunity over those many pitches?
I think a combination of confidence and knowing the story and knowing the types of questions that investors are going to ask, right? So a lot of them ask similar questions. After answering the same question 20 times, it's like top of mind. And some questions that at first I didn't have the answer to, I would go back, meet the seller, ask the questions. And along this process, I'm also visiting the seller like once a week, talking, negotiating, asking questions, doing my diligence. So I think you're just more knowledgeable about, the business at this point, right? Like how many under contract? Why was there so much growth this year? Why did margins compress? So you just get more familiar with the story. So that helped a lot.
Mm-hmm. Great.
So at this point, moving on to the debt, we're starting to talk to the SBA. We have like 3 term sheets, and then, we start getting commitment letters, right? But they're coming short of the 6.5 million, like 5 million, and we can do 500K and a 300K, credit line at close. And we want to see you close with more debt, with more cash on the balance sheet. So then you start playing with like numbers, like, okay, maybe I can close with less capital on the balance sheet. And the long story was we were coming up short, right? Any way you slice it, I got to raise more equity, or I got to give up more debt, right? So at this point, I'm like, okay, I'm short 700K of equity, 500K of equity. And, we're getting creative saying, okay, instead of closing with 500K on the balance sheet, let's close with 200, which is getting too close to comfort for me, right? I got 15 people I owe money to, and I got to start paying, and I got debt, and I'm going to close with 200K. So, we decided to look for other lenders that would, write a bigger debt check. And we got introduced to a fund named Stonehenge Capital through some common contacts, and Sig had a connection there as well. And I talked to them about the deal. They really liked it, and this was an impact fund. They had like a $250 million debt impact fund. This deal qualified because it was in an opportunity zone in Florida, and because I was a minority Latino. They liked the deal, and they gave me a term sheet as well for the 6.5 million. SBA was at 5.5 and with less cash, etc. But it was more expensive debt at the time, right? It was more expensive interest rate and certain things. Not the only good thing, but some positives of this lender was that they could provide more capital for add-on acquisitions. They weren't limited by the 5 million, and I didn't have to provide a personal guarantee. I did have to provide a guarantee of all my assets pretty much, but it wasn't like an unlimited personal guarantee. So at this point, I gotta make a decision now. Should I go with the traditional lender and the small investors, or with the SBA? But I gotta go and raise more equity, right? So even though the debt from the traditional lender is more expensive, I don't have to raise the additional equity, so it ends up being about the same, right? And
you're calling Stonehenge a traditional lender, but to be clear with everybody, so they're a kind of a lender. They have this $250 million to deploy as loans in an impact fund that meet these certain criteria, which you meet, your deal meets. But they're not a bank, as it were.
No, they're exactly.
Totally outside of SBA. Okay.
They're a private equity lending fund. They're larger than that fund I mentioned is just one of their funds. So they're a little larger.
Okay.
A lot.
Okay.
So at this point, I haven't made a decision. I want to get a commitment letter from both. And I'm negotiating with the SBA, getting a little more, and with the lender, getting more favorable terms. So at this point, SIG is like, you better keep calling investors. If you need the extra 500K, get some other investors to commit, right? So I start following up with some people that hadn't replied to my emails. And one of these family offices replies, yeah, sorry, I read this deal, I liked it, but life got in the way and I never replied. I'm ready to listen to your pitch. And SIG tells me, yeah, this is a very big family office. They would be a great partner. They could potentially take your whole check. So I go and meet with them. I meet with George, who's maybe the managing partner of the family office of the capital provider. And we really kicked it off. They are operators that have experience with lean manufacturing. Because I was a General Electric, I learned a lot about lean manufacturing. So we had a good presentation, and he really liked the business, the deal. So at this point, I'm like, we're raising $200K because we got most of the commitments. And he's like, let me get back to you. And the next day, we jump in a meeting, and he's like, we really like you. We like the business. We like Florida. We want to take the whole check. We want to take the whole investment. I'm like, wow, that's pretty cool. What does that look like? They're like, we're not a traditional, self-funded search investor. We'd be looking for more equity. We want to be partners. We have an infrastructure. We have more team members. We're backing 4 other strategies similar to yours. And, they basically put me in touch with the guys that they've already backed. And it was definitely more expensive equity. So, at this point, the clock is ticking, and I got 4 ways I can do this deal, right? The small investors and the SBA, the small investors and the traditional Stonehenge fund, the large investor and the SBA, the large investor or Stonehenge, right? And I don't know what to do at this point, right? They all, from not having anything, now I have too many decisions and I don't know what decision to make. And, you start asking your mentors, your friends, and of course, all of them have a different view, a different opinion. And long story short, in the end, I decided to go with the family office and Stonehenge for, I saw an opportunity to take this company into a platform and then do more acquisitions, right? Based on my experience, I'm like, okay, there's something to be thought about starting with one, buying more, putting them together. What am I going to need for that? I'm going to need a partner with more money, who's not scared of taking risks, and I'm going to need a lender who can provide add-on capital. Maybe I'm going to have a smaller piece of a larger pie. And then, to be honest, then I had to go to all the individual investors. This decision, by the way, I made it like a week before close, because SIG advised me, like, don't say no to anybody until you know what you're gonna do. So at this point, I make the decision to go that route, and I gotta go and tell the individual investors. At the end, they believed in me and they were gonna trust me with their capital. So it's tough conversations to go and like, hey, sorry, but I'm going with somebody else.
How do they react to that?
I mean, everybody understood it. At the end of the day, they're all deal makers and stuff like that. Some were definitely disappointed, like, can we get in on this secondary deal, etc. But the large investors was like, no, we don't really need more partners, right? So
let's be super clear with the audience. I mean, you've said it, but the learning here, or the what was the ultimate kind of what made the decision for you was you are thinking bigger about subsequent acquisitions to this one, that this becomes a platform and that you might do some kind of roll up or multiple acquisition strategy. And so to do that, that really favors sources of capital, both a lender and equity, that can write you subsequent checks. So if you're looking at, raising a lot of money from a lot of little checks from smaller investors, well, when the time comes for acquisition number 2 or 3, you got to go back to all of them. And, it's just going to be much harder to continue raising money for future deals. So the learning here, or the thing for the audience is, maybe don't just think about this first deal. Think about what you really want to do with the business that you buy. And if you're thinking about that you might want to do multiple acquisitions later, then think about that strategy right now. And the capital partners that you choose, maybe, you might prioritize the deep-pocketed ones as opposed to others. So
100%. And there's no right answer, because I think I could be in the same spot had I gone with the small investors. Had I gone with the SBA, I could have still ended up in the same spot, right? The path might look a little different. So there's no right answer. I just felt this was it was hard for me to think owing like $100K to 15 people and having to repay that, because that deal structure, it was like preferred equity with an interest. And I felt like, based on the condition of the business, like I could see it needed not a lot, but some investment in infrastructure, maintenance, and CapEx. So the path with the smaller investors was going to suck more cash out of the business, not allow me to focus on investing and growing, versus the path with the large investor. He's like, we don't need to get paid back. We want you to invest. We'll put more money if you need it. So basically I felt I would have a funner time in that situation.
Yeah. Wait, sorry. So you weren't going to have to pay a preferred rate to the big investor?
No, it's still a preferred investment, but with no interest on it. So I'm not incentivized to pay it as quickly as possible.
And right. So just to be clear with the audience, typically in self-funded deals, like the kind of typical structure that you see with self-funded investors is the money they give you is kind of this hybrid loan equity. So if they give you, say, $100, so one self-funded search investor gives you strikes you $100,000 check, you pay interest on that $100,000. It used to be kind of 8 to 12. Now people talk about it being 10 to 14% as rates have gone up. And you're paying the interest on that $100,000 until you pay all the $100,000 back. And then they also have a piece of equity in the business based on whatever you negotiated, whatever that $100,000 should be worth. And so then they keep, piece of your business forever. But what that means is that you're paying, this heavy interest. There's a lot of interest that's just going out the door every month, because it's basically, a debt instrument as well. And so leaving you with less cash to invest in your business, and you wanted to avoid that.
Yeah,
And this was pretty unusual. I guess I don't know the whole universe of self-funded deals, but this was a pretty unusual opportunity to be able to, have this debt and not and equity and not have to pay kind of really pretty heavy, 8, 10, 12, 14% interest on it. All right, carry on, please, Luis. This is fantastic.
So at this point, we're getting close to the end of the deal, right? Like I got the lenders, I got the investor, I made my decision. I was able to structure the real estate acquisition with the seller note that the guy gave me, and he reduced the asking price from 5 million to 3.8. So I basically raised 800K from friends and family, let's call it, and it was like an arm's length transaction, right? Like I bought the real estate separately because the investors didn't want the real estate, and we just rented the business to the real estate. So that's what ended up happening on the real estate side. And he gave me a $3 million
knocked down
seller.
the price. He knocked down the price that much.
Yeah, nice guy. I mean,
was the original $5 million price not really market? Was that like well above market? And why was he so Luis? Why was he so eager to get rid of the real estate when, assuming $5 million for this piece of real estate was market? I don't know commercial real estate very well at all. I really know nothing about commercial real estate, but I assume if you have an asset, a real estate asset that's priced at market, it shouldn't be that hard to find a buyer. So why did he have to sell it to you?
Yeah. So I think he was like a conservative gentleman, and there are some risks in this type of business with environmental concerns, right? Dry cleaners in the past used different like chemicals. So he's like, I don't know what you're going to do with the property. I don't know what you're going to dump. And in the end, I'm going to be responsible for that. So I don't want to keep the real estate. So I actually had to do a bunch of environmental tests because, I also don't want to be exposed to that. So I had to do what is called a phase 1 environmental test, a phase 2, and kind of cover all my bases. But that was basically his hesitation. He's like, I don't want to be a landlord. I don't want to, have to worry about what you're doing here. So he's like, in order to get this done, I'll lower the price. I'll give you a huge seller note and let's get it done, right? So he wanted to get the deal done. And yeah, I would say market for that property is and was 5 million. It's even a little higher now. So, we got a good deal there, and it's $3 million of seller note at 7% interest only for 5 years. But his whole point is my debt is secured by the real estate. If you want me to give you a seller note on the business, it's not secured. So he gave me $100K seller note on the business. Because lenders still want to see a seller note on the business. We actually flipped a coin on it. I'm like, I need a small seller note on the business. This was when I was trying to bridge that $500K gap because the SBA wouldn't give me more. So I'm like, I need $500K seller note. He's like, I'll do $100K. Let's flip a coin. If you win, you got $100K. I'm like, okay, $100K. I'll take it. Let's do it. Heads or tails. He flips it out, throws it, and I actually get it. And he's like, okay, congrats. You got $100K seller note. and he ended up giving the seller note.
Okay. Like you said, nice guy. All right, Luis. Okay. So does that is that the end of the deal? Does that get us across the finish line?
Yeah. I mean, we circling back, I chose the family office, Stonehenge, and then we get to the closing, which is way more unpivotal than I had imagined. It's like, you just get on a call and like the lawyers release signatures. The problem was we go to his office on closing day. Everything is lined up at this point. The guy's air conditioner is broken the day of closing. So we're in his office the whole day, sweating and, just getting with the lawyers and this and that, finalizing everything. The AC is not working. It's 4 p.m. and like, okay, wires are ready, right? And, we receive all the wires from myself and that, but the main wire, the main investor's wire, it's 4 p.m. and the wire never came, right? And at this point, like I'm getting nervous. The family office, like, yeah, we sent the money, but today is like the final day of tax closing or something like that. So Morgan Stanley had a delay, and it should be there shortly. So basically, it's like, okay, it's 5 p.m. Money never came. We're all worried at this point, and we go home and like, okay, let's come back tomorrow. And evidently, like 8 a.m. the next day, the wire came, and we had the closing the following day. So sweated all the way till the last minute the deal.
Literally and figuratively. Okay, and then Luis, one of the things that we had talked about in the pre-call is like what you would have done differently, or reflecting back on your search, how could you have done things better? So share that with us, please.
I wouldn't change much because obviously it all worked out. I would say I underestimated how complex it would be to run this business, the first one at least. And, you don't see the whole picture when you're going there for 1 hour, once a week. You don't see how complex it actually is. And I think the seller, not to his fault, he'd been running for the last 6 months to optimize for profit, right? Just keeping the wheels on this thing, charging as much as possible, investing as least as possible, taking as much money, knowing that he's going to sell. And then I acquired the business, sometime in November, when the busy season for this industry starts. All the snowbirds from north are coming, Miami's booming. So I acquired this business, with a lot of deferred capex, the busiest time of the year. And one thing I didn't mention as one of the conditions of this guy doing a deal was he would give me a 30-day transition period. 30 days, that's all I would get. Mm-hmm. He said this pretty early on that, he was going to give me 30 days. He was going to be here from 4:30 a.m. to 1 p.m. every day for 30 days. And that was it. So
4:30 a.m., is that when the day starts in the linen cleaning business?
The shift starts at 6 a.m., but the crew starts coming in at 4:30 a.m. to turn on all the infrastructure. Like that's the point I'm making. Like there's a lot to running this business. You got boilers blowing steam across the whole building, burning natural gas. You got water systems. You got huge industrial irons that need to be fired up. You have a compressor that fires air throughout the plant. You got, 10 washers, 70 employees, 8 trucks, 500 customers. So it's a lot, and this guy was doing a lot. He's running payroll every day, depositing checks, fixing machines, fixing washers, turning on the plant. So, that's when I'm like, okay, running a business, especially this business, is no walk in the park. So, in hindsight, I wouldn't have done anything differently, but I do think I paid a little bit more because I ended up having to spend like maybe $500K on maintenance capex that he should have done probably,
How could you have diligenced that better? I mean, what do? Get a third party to come in and look at all the equipment and give you an opinion on what needs to be
I had that
upgraded?
Done. I had that done. Yeah, I would say I did a very thorough diligence. I had experience in my private equity days doing thorough diligence, so I had a pretty thorough diligence. I think it's just the reality of running a business is like, he never not told me anything. He was very upfront. The plant is old, stuff is old, you got to fix it. It breaks all the time. So he never hid it. That's just how he ran it, right? So I think there wasn't much I could have done differently, to be honest. Just maybe be a little more prepared. I certainly think if I had gone with the smaller investors, I would have run out of money. If I had closed with $200K of cash and having to pay and their preferred return and having to invest more than I expected, I would have probably run out of money.
And so, sorry, to be clear, the $500,000 that you put in to the business came from where? That you put into the business in these first months for the capex, right? Did I hear that correctly?
Yeah, it was. The business is cash positive after debt service, so I generated some, but I also closed the deal with $500K on the balance sheet.
Great, and so let's talk a little bit more about this, the operations and what you found. First of all, to this question about the CapEx, so you put in the 500. Did that once you so it was disappointing to see that there was actually going to be more CapEx than you thought, but you do it. And then do you feel like things from that perspective, the CapEx perspective, kind of stabilize and you kind of like swallowed the bitter pill, but it's behind you and now you're comfortable, sort of thing?
Absolutely. But it wasn't like 500K right out of the gate. It was like a bunch of little things, like, okay, the belts on this iron hadn't been changed. That's 15 grand. The air compressor, it's old. It hasn't been maintained. That's like 70 grand. And it's not quick projects. You know what I mean? Like these are big stuff. You got to haul it out, procure the new one. So it's over a year. I've invested in the infrastructure to create a better business. So I'm a little less profitable in my first division because I've invested in people, in machines and everything. But I'm coming after 1 year into the same busy season in a much better spot, right?
Yeah.
There last year, I just remember it was like problem after problem, right? Like water flooding, machines down, trucks breaking. And to this guy, that was normal. That's how he ran it, right? Like not spending, but, firefighting all day. So, that was my first 3 months was just root causing. Why is this problem happening? How do we fix it at its core and get everything to a much better spot? So our first company is now much more stable and ready to like grow by 20-30% and not be scared that, the wheels are going to come off this thing at any moment, which it was what it felt like when I had just closed.
And so when you were dealing with that, the operation, you're basically firefighting, you're picking up the firefighting that he was doing and now you're doing it. Do you think that you were really leveraging your operational experience there? I mean, was that real experience that you were bringing to the table, or could any searcher kind of come in and done the same root cause fixing?
No, definitely my experience working at GE came very handy because at GE, I would rotate across factories every 6 months, working on the shop floor with machines, people, utilities. So I would tell you, your average person who worked in finance or something like that would have had a tough time. Like I was, troubleshooting machines, hauling waste. Like it was a lot of hands-on stuff that, it was hard. And I think the way the seller ran the business, he liked to do everything himself. He fixed the machines himself. I took a different approach and empowered my employees to learn it. You learn from Mark before he leaves in 30 days how to fix that machine because I don't want to be fixing machines. And they learned, like everybody bloomed. And I think it was just, this old school mentality when this generation, he felt like he needed to do everything and he didn't trust the team too much. I was a little different. I'm like, I want my team to be empowered to do it because I shouldn't be doing these things. So, but I also needed to learn how to do these things before I could outsource them. You need to know how to do everybody's job so that you're never at the mercy of one single person. And I did over the first 3 months. I went on a truck, I loaded washers, I ran dryers, I put napkins through, I packaged them, I visited customers, I did payroll, I received checks. So at this point, I can do anybody's job, but I shouldn't be doing anybody's job, right?
Yeah. Well, that's I love that, Luis, because I think a lot of searchers get in there and they learn as much as they can, and they with the idea that they're going to be the primary operator. Now, you clearly are the operator, but you've just got this orientation to be working on rather than in as quickly as possible. I mean, you're very delegation oriented. So you're got this learning curve. You're learning as much as you can. You're fixing machines, putting out fires. What about just psychologically? How you doing? So you've said it's hard work, but what does it feel like? First of all, you've consummated a deal. You're living the dream, right, Luis? I mean, this is what you had been trying to do, and now you're doing it. What's your emotional state like during this transition?
I would say stressed, like stressed, working long hours. I never woken up at 4 a.m. in my life, much less to like go to work, right? At this point, I'm waking up at 4 a.m. every day to show up at work at 4:30 a.m. And, I kind of learned a lot about waking up early. Many people say it, but until you do it, basically it's 9 a.m. in the morning and I've got like 6 hours worth of work and I still got the whole day ahead of me. So that was cool to learn, waking up early before everybody, before the sun comes, and you like waking up with the sun, working with everybody. It was a cool experience, but it takes a toll. I was working 4 a.m. to like 6 p.m. You got adrenaline like kind of moving you forward and learning. So I'm tired, I'm stressed, I'm scared, like, because I got a lot of debt too. That's another added pressure. I got covenants and a lot of debt. I got to make debt payments. I got to maintain this company being profitable. I got employees who, I don't know what I don't know them for long, right? So I would say stressed and worried is a good word to describe it. And at some point, I'm like, what did I do? Like, I miss my job. But
Really?
you gotta, yeah.
Really?
Some days, still, I this is 24/7. Like I don't, you can't turn it off, right? Like it's problems all the time, customers all the time. When I had my job, you clock in, you clock out, you still give it your all, but at the end of the day, it's not really your problem. Here, you got 110 people's livelihood on you. You owe a lot of people money. You got 500 customers that are depending on your service. You got all these machines. You got your family that you need to prioritize. So it's hard. I mean, it's not easy, right? It's fulfilling. It's worth it. I wouldn't change it, but it's not easy for sure.
Well, in those moments when you fantasize about just being back in your W-2, what do you then kind of snap out of it? How does that feeling not become bigger and bigger and bigger? Or does it? Maybe it does become bigger and bigger and bigger, but you just said you wouldn't change it for the world. So which is it?
I mean, not to sound shallow, but then you just think about the end, right? If there is an end, and then you think about the economic value that I've created, and then you come back to reality, right? Like I would have never been able to do this. Sure, I have all these problems, but even though the reward of it is not real yet, it's certainly, well, it's not in my pocket. The value that we have created and the reward economically that I'm going to come out of it kind of snaps me back out of it, and that's not why I do it, but that's what, when I'm having these second thoughts, it's like, okay, it's harder, but there's going to be a reward someday. There's already a reward because now, like you're empowered, right? Like you have all these people depending on you. You don't have to ask anybody for permission, pretty much. You're the decision maker. And that's one thing I don't miss about my prior jobs is you were never the decision maker. You always had to ask permission. You always think you know more than your manager and you would do things differently, but you can't make those decisions yourself. You got to play politics. Here, the ledger is all that tells the truth, like your scorecard is your P&L, your revenue growth, your customers staying. There's no BSing your way here. When you're at work, you do your work, you succeed, but at the end of the day, you still get your paycheck. You do good or you do bad, you're gonna get a paycheck.
How much management experience did you have working in your career before this?
I would say quite a decent amount because at GE, I would be in charge of like production team on the shop floor. I had a couple of associates working for me. So a bit. I was never like the boss of 100 people, but I did learn, how to be a good leader, how to motivate people, how to treat people. And I think that's very important, right? Like knowing how to deal with people because at the end, I'm just one guy. They're the ones who run the business, and you got to take care of them, and it's competing priorities.
Well, how is it different being a boss of 100 people and also in kind of a blue collar environment versus, a smaller handful of people? I guess maybe in you also had teams on the production floor, as you said, that you were in charge of, but also that you were a manager of associates, so kind of white collar types. Anyway, this experience of running 100 people, managing 100 people, being the boss of and the source of a paycheck for 100 people. Talk to us a little bit about what that's like and how it's different than what you're used to.
I think, you gotta find yourself as a leader. Like, what kind of person are you going to be, and what kind of tone are you going to set? And there's no right answer, right? Like, the question I asked myself at the beginning is, do I want to be fear or do I want to be loved by my workforce, right? Do you want to be, this hard ass, like, work and, pushing people, or do you want everybody to just admire you and love you and work because, they love you, right? And I wasn't sure, I wasn't sure what angle I want to take, because I had seen both during my experiences. And I asked a mentor of mine, and he said, you want to be respected. You don't want to be feared. You don't want to be loved. You want to be respected. You want to treat people with respect. And you got to be tough when you got to be tough. And you got to be empathetic when you have to be empathetic. And it's a constant balance, because running a business, you have so many competing priorities, right? Your customers, what do they want? They want lower price, better service. Your vendors, what do they want? They want higher price and to squeeze you. And your employees, they want more salary. And what are you ultimately trying to do? Run a more profitable business, right? So you constantly have to be saying no and know how to say no, right? You want a raise? I would love to give all these employees a raise because they're working hard. They're doing all the work. But at the end, if I do that, I can't pay my debt and we'll all be out of a job. Same with the customers. I'd love to lower the price, but I got to increase my wages for my employees. And so, I've learned a lot how to say no, but still, find a solution to problems, right? Find a common ground. But I think that's one of the things I struggle with all these employees is, of course I want to give them more money, but I can't. But if the business does well, probably more money will come. And it's kind of like the chicken and the egg problem, right? Mm-hmm. So, I think I've learned to balance it. And, one mistake I made is I gave everybody a raise too early on. I gave, like, within 2-3 months of starting, I gave everybody like an 8 to 10% raise. I did my calculations, and because these are folks that are making, low wages, right? It's the lower end of the wage spectrum. So I did some quick math. I said I can probably stomach a wage increase, especially to the people who make lower money, pass on customer increases. But I underestimated, when you increase wages, says your workers' comp increases, your payroll tax increases. When there's overtime, it's exponential because you're paying time and a half, double time. So I was a little too early to increase wages. And I got a lot of pressure on the financials, and I couldn't pass along as many price increases to the customers as I thought I could. But in hindsight, I think it was the right thing to do. Mm-hmm. But maybe it was a little too early, right? Because now everybody's expecting a wage increase again, and this year I probably won't be able to do it. So it was early for the reason that you just explained, but it also sounds like you undercalculated a little bit. Yeah, you did. Yeah, okay. You didn't see that if there's all these other costs that are proportional and tied to the wages of your employees. So you increase the wages, and it second order effects is that it increases these other costs as well, like taxes, like overtime. And I would say, when you jump in, you think you're going to be able to accomplish more than you actually can, right? So I'm like, oh, I'm going to optimize routes. I'm going to implement this system. I'm going to negotiate all these things, and I'm going to, get so much more profitable. I would say I overestimated how much, I thought I could do. And in reality, just running the business was like hard, right? let alone, optimizing it for profit in the first year. So I would say, it's common when you buy a business, don't expect, some are really great and they grow revenue by 30% and EBITDA and it's really quick. But I would tell you that, it's more realistic when you buy a business the first year to expect, and don't be scared of some margin erosion, some small revenue decrease. And I would say if you're going to be highly levered, to take that into account. Don't just think, year one, I'm going to be up 5% and my EBITDA is going to increase. Because if I go back to my models, that's what they said, and it's not a reality, right? You got to take a dip before you can go up when you're buying these small businesses.
Right. The J curve. Well, the thing is I if we were just talking about Size Linen, the name of their business, we haven't said that very clearly. Size, CY''S Linen. That would be true. But the thing is, you bought a second deal. Now, we're not going to have another hour to tell that whole story. You're going to have to compress it into about 5 or 10 minutes here. But we got to hear this, Luis, because it's an incredible, second deal to have done within the first 12 months of the business. And it really changes the trajectory of your business now. I mean, with this platform, if you kind of consider these both as the platform, you've got quite a platform now. So let's hear the abbreviated version of the second deal.
So basically 3 months into it, the seller of the first business gives me a call. He'd been visiting from time to time. He says, you're doing a great job. I think you're ready. I got another deal for you. Because I struck a deal with him. If you bring me any add-on deals, I'll give you some sort of like finder's fee. So he brings me this deal. He's like, it's a commercial laundry down in Key West. It's a buddy of mine. You interested? I'll set up a meeting. So I met with the gentleman. He came to Miami. Again, we built a good rapport. We told him what we had done. We basically said we can get this deal done. It was $3 million in EBITDA. So it was quite big, right? It would more than double us in size. And of course, we excited to explore it. But some questions, I'm barely just getting to learn how to turn the lights on in this first one. At this point, I'm a little more confident, right? Like, okay, after 3 months, nothing has gone terribly wrong. We're still here. Why not, right? So met with the gentleman. We agreed pretty quickly on a price for both his real estate and his business. Then I went to Stonehenge. Hey, you said you would double down and you had deeper pockets. Here's an opportunity. They were hesitant. Because they're like, are you sure you're ready for it? I mean, you're just getting into it. This is a big deal. And, this is where you kind of have to play a little tough. And it's either with you guys or we're going to refinance you and do it with somebody else. Dallas is all over it because they this is what they want to do. This is the family office that is backing us. So we decide to go down this route and go into diligence. This is December 25th. We're starting diligence. So I flew with my family to Switzerland, skied one day down the mountain, spent Christmas with my family, and jumped on the plane on the 26th to keep running this business. And, didn't spend New Year's with them. So you got to make sacrifices, right? So we engaged in diligence. This was a much newer business. He had just made a big capital investment in investing in machines. So new machines. The end market was hotels. So now we had restaurants and hotels with this operation and a lot of synergies. So we got into the deal. Long story short, middle of March, we closed on the second acquisition. And we were able to leverage the value of the real estate to do a sale leaseback transaction and minimize the cost of the business itself. Because we agreed on a certain amount for business and real estate. And then, we used the real estate to maximize the value that we sold the real estate in the sale leaseback transaction. And
wait. So you agreed with the seller to have a blanket sum, and the goal was to increase the ratio that the real estate represented under that blanket sum and reduce the business price.
Correct.
Ratio,
by being able to afford a higher rent in the real estate because it's a very high margin business. We go and we say, okay, this business could afford, call it 350K in rent, right? Right now, he owns the building and the real estate, so it's free. But if I go to an investor and sell this real estate with a 350K lease, that implies a value at a 7% cap rate of $5 million, right? So we think we can go and sell this real estate simultaneously at close for $5 million, reducing the price of the business by a great amount. And that allowed us to be able to fund the entire transaction of the business with debt and a little equity, right? So we basically didn't have to put much equity of our own or our investors to get it done. So fast forward at close, our first business was doing a little better than we thought. Even with all the cost pressures, we were doing about 2.2 million in EBITDA. And this business at the time of close was doing like 3.3 million in EBITDA. So, very quickly after 6 months, we were, 5.5 million in EBITDA. So a scalable operation at this point. And, my focus right after close was on integrating both businesses as much as possible to the extent that we can do it, because it's two separate factories. But for example, I merged all the financial systems all into one. I merged all the payrolls into one, all the invoicing, basically all the back office I took away from the Keys operation and brought down to Miami to let this business focus on operating and, build out my back office team in Miami. And then now we're getting to the point where we got to refocus on growth, finding more customers. And we're always actively looking for add-on deals. We have, a pretty healthy pipeline, like 5 other acquisitions in the pipeline, anywhere from 200K in EBITDA to 8 million in EBITDA. So, to do a large one like 8 million maybe is a little bit of a stretch, but, we just see what makes sense at this point. And
well, your first deal was a stretch. Your second deal was a stretch. So you're 2 for 2 on doing deals that were a stretch. And so just to return to the numbers so people are totally clear, your first business, the one we spent the most time on outside Miami, was 1.5 million EBITDA. It has since grown to 2.2. The other business, when your first seller brought you the deal, the Key West deal, it was doing about 3 million in EBITDA. It's now at 3.3. So 2.2 plus 3.3 equals 5.5. So in about 13 or 14 months, you went from an aspiring searcher to a guy who has a business generating 5.5 million in EBITDA. Obviously, you have a debt and equity, so it's not 100% yours, and and there are a lot of things on your shoulders. But this is a substantial business, and then you got this pipeline of opportunities to continue building this. I mean, you could get this to. I mean, I don't know. I mean, if you buy an $8 million EBITDA business, so you'd be at $13.5 million of EBITDA if you did that deal, which I recognize is a stretch. I mean, what are multiples in this space? I mean, if you got to 13.5 million in EBITDA, what would the multiple on that be? Don't be shy.
Probably around 10 times on 10 times, because you got to remember it's recurring revenue. It's almost like a subscription model, right? At 13 times, there's a lot of comps between 10 and 15 times in this space. Some in the healthcare, which commands a little higher multiple. But yeah, that's the angle we're playing, right? The bigger you get, the higher multiple you command. And this is a 100% contracted, highly recurring revenue business. So the multiples are quite attractive when you get to scale, right? So that's the idea here, is that 5-6 times, multiples aren't 10 times for sure, but higher than 2, 3, 4 times, which is the multiple you could get for anything between 200K and $1.5 million in EBITDA. So you start creating some multiple arbitrage when you acquire these smaller targets. I think the problem is this is a tough business to run, right? It's not you just scoop up a couple of plants, right? They're all a business in itself. So really the angle that we're looking at is acquiring routes from smaller plants. Like, we don't want your plant, but we'll buy your route and put it in my plant. And then there's a lot of organic growth. And right now we're only in South Florida. We've been, looking at deals outside of South Florida. But we got to take it one step at a time, right? There's days where I'm confident. There's days where, I have so many issues. I don't even want to hear about this business and want to sell it tomorrow, right? So I think it's just taking one step at a time, not losing vision of where you want to go and the big picture, but not living in a dream of what it could be. Like I gotta protect what we've built here, think about the future, but not get too ahead of myself thinking, I can do all these things. In order for us to continue to scale, I think I have to hire more people. I've been a little shy about, really investing in middle management, because right now I've been kind of like, I bought this, I want to maintain these margins and this profit, and you got to invest a little bit more in your upper middle talent to be able to go all out. So I think that's the natural next step for us, is to kind of hire some more folks that can, help me keep running this business.
It's interesting to hear you struggle with that decision, Luis, because when you were doing your deal, you were able to recognize that it was in your interest to give up a little bit of equity. In other words, more expensive. It was more expensive to you to do the deal with the partners that would long term, it would be worth it. But it seems like when it comes now that you're in the business as operator, you're struggling with separating yourself from some of that profit to again make a longer term investment in people. And just to be clear for your plan, as you just said, one step at a time, don't get too far ahead of yourself. But the idea here is kind of roll up at this point where you would think, after you got scale, you don't know when exactly, but let's say you get scale, say you get to EBITDA of a certain level, you've got a management layer, then sell or hold forever, or what? Or you don't know?
I mean, yeah, that's the question of the $1 million. I don't know, right? Like the core investment thesis is, 5-year hold, right? Let's do this for 5 years, see how far we can get it, and then exit. That's the dream, so to speak, right? Like, and then, do it again or become an investor, or, take some time off. I don't know. But I don't discard, if we built a great business, why not keep it forever, right? Once, if you can build a business that constantly produces, why not keep it forever? And then there's also, if somebody comes tomorrow and offers me like a great offer, we've created a lot of value real quick. Why not sell it real quick and then go do something similar in a different space, right? So I don't like to limit myself to one path. I think the main path, or our initial thought was, let's do this for 5 years. And, we'll look at what we need to look at as opportunities present themselves. I'll say it's harder than I thought to do it. Like, to do a deal was harder than I thought. To raise the capital was harder than I thought. To run a business was harder than I thought. So I think, the message is nothing in life is easy, right? Anything worthwhile is gonna be hard, and you're gonna have to do a lot of sacrifices, right? So I would say, like, I wouldn't have been able to do this without my family, my brothers, my sister, my parents, my wife. Like, they all instilled the confidence in me I needed to get to this point, right? Like, they were always, you can do it, go, like, what's the worst that could happen? So everything I do is kind of to try and make them proud one day and say, this is what I did. And then I think the path has been a lot easier also with the partners that I ended up choosing, right? Like, Stonehenge has ended up being a great lender, a great partner, and Talus has been a great partner as well. I've had a lot of offsites with them in their offices in New York. I've visited all the other searchers that they've backed, and they've even come down to my business multiple times to help me with some projects. So I think, it's all turned out great. And, now we just got to keep going.
Well, when I hear you talk about how hard all these things are, so much harder than you thought, it's hard for me to square that with the incredible progress that you've made. So yes, hard, but still very fast. I know I've said this now probably twice. I'll say it a third time. $5.5 million EBITDA business in about 14 months of hard work. That's I take that. I take that 14 months of anybody can suffer for 14 months if that's what's at the end of that particular rainbow, and you're only getting started. I mean, you got all this pipeline now of other deals you can do. Let's close out. I want to just ask you a personal question. You touched on your family, your extended family, but let's just hear a little bit about you. You said at the beginning you got 2 kids and a wife. You said you had to cut your Christmas trip to Switzerland short. I know from the pre-call that you were back and forth to Key West from Miami in the early days of the second acquisition. What can you say about how this has affected or not your family life?
I mean, I would say I've had to sacrifice many moments that I wish I could be there for. I wouldn't say like I'm missing out on life, but that example when I had to fly back for New Year's, because all my employees are working. Our busiest time is New Year's. So, what kind of leader would you be if like all your workers are working and you're off, in a hot tub skiing, right? So one, I felt like, after 3 months of buying this business, I need to show, my team that I'm there in the trenches, even when I wish I wasn't. And I had this deal that it was like, we got to close it. So I got to focus on diligence, etc. So yeah, I mean, that's the sacrifices you have to make. Today, I'm in the Keys, right? Come 2 days every week to check the plant out here. That's time I don't spend with my wife and my kids. But I try to make up for it in the moments that we are together, being present, like doing fun stuff. When we take a vacation, being there 100%, and having them be a part of the process, right? I've brought my daughters to the plant, and they don't really understand, but you want to make 25 cents, fold those napkins there, put them on the chair. Literally, that's what I did with my older daughter, and she's like, I want to fold more. So it's tough, but I think it's part of the process, right? My dad always said, like, life, you have to do it like an X, right? It's a balance. You have friends, you have family, you have work, and you have sports. There's certain periods in your life that you're gonna be more towards friends, more towards sports, more towards family, and more towards work. I would say right now my shift, it's a little more towards work, but hopefully after a couple of years I'll be able to go more towards family. So
yeah,
it's what it is.
But Luis, sports, that's one of the quadrants.
Exercise, exercise, being healthy, exercising, health. Yeah, not sports, but exercising.
I was like watching football or something. I was.
That's also important. But no, I would say staying active and taking care of your health is very important.
Right.
Sometimes you're like busy, but going for a run, going to the gym, you'd be surprised. Like that's just as important as putting in the hours, because it gives you like mental clarity. Like I'm not a gym jockey, but you gotta try to stay active, I would say, is important. And I don't do it as much as I should, but it's one thing you gotta think about.
This isn't that season. You'll return to it when it becomes that season again.
Exactly.
Luis, is there anything that I didn't ask you or that we didn't touch on that you wanted to?
No, I mean, I think we had a pretty holistic conversation. I think I'm lucky to get to this point, and I don't want people to think this is easy or this is the norm. Like you got to work really hard. You got to be a little lucky, but it's a lot of persistence. I remember when I was in my search, you almost think you can't do it, and you got to keep going, right? It's not easy. And, I want to encourage everybody to try it because it's a big opportunity. And just how I got lucky, if people take that leap, I think many people can get lucky. And I think we're in a phase where it's an interesting period where there's a lot of baby boomers transitioning out. And there's not a lot of young generation who want to enter the linen business, right? So there's a lot of these old robust industries that need to stay, and there's an opportunity for young aspiring operators to take a leap and take a chance, but it's not easy, right? Like sometimes I miss my job.
How can people reach out to you? How do you prefer they reach out to you, Luis, if they want to ask you a question?
Yeah, they can shoot me a message on LinkedIn. Happy to exchange contact information and chat from there afterwards.
Luis Aguilar, I'm hearing you that this is really hard. So I'm not diminishing that, but it's still eye-popping what you've been able to accomplish in 14 months. So I want to congratulate you for that, and this will really excite people. So thank you very much for coming and sharing and being transparent.
Thank you, Will. Thanks for having me. It's been great.
I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come. Stories that will help you along your own path to acquiring a business.